Welcome to our first call, right? We're going to be talking about structure, which is very, very important, right? We're going to be talking about structure. Uh, Structure is very important, right? Let me. So structure is very important, right? So we're going to be talking about structure. We'll rush through the, we'll rush through the basics and we'll rush through the basics and also then we'll move straight to the advanced. So when we talk about the basics of structure, right, which is also very important that we understand what it is all about, right? The basics of structure, which is the theoretical aspects, anybody can actually wake up any morning and teach that is when, price starts to give to you, in a bullish market condition, price gives to you what we call higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, right? So this is a bullish market condition, right? So this is theoretical, right? This is a bullish market theoretical aspect of it, right? And the market is never always going to be like this. It is not always going to be like this. And we have the bearish part of it, which says that in a bearish market condition, the market will give to us what we call consecutive lower lows, right? The market will give to us what we call consecutive lower lows, right? So one of the things I always love to add is that whenever you see that the market is actually in a trending market like this, right, there are two major characteristics I love to emphasize on that people really know. And the first characteristics of either a bullish or a bearish market condition is for them to understand that every higher high in a bullish market condition, every higher high is an external range liquidity, right? And every higher low that is being created, every higher low, when I say every higher low, every higher low is an internal range liquidity, right? Internal range liquidity. So the higher high that is being created in a bullish market condition is called an external range liquidity, and every higher low in this particular bullish trend is known for two things. Number one, they are known as structural points, and also they are also known as uh, internal range liquidity. So when we say they are known as structural point, this is what I mean. So let's say, for example, the market is actually moving to the upside, right? Creating for us higher highs, higher lows, higher highs and higher lows. So like I said, the higher lows that are being created are known for two things. Either they are internal range liquidities, or they are going to be known as internal range liquidities, or they are known as a structural point. So what do we mean by the word structural point? It means that if price trades and breaks below this, this particular low, right? Breaks below, let's say, two structural points, right? Which are these higher lows that are being created, right? If price breaks below these particular two structural points, right? One of the things we're likely going to see is that it means that price is going to shift its directional bias from a bullish structure to a bearish structure. So what we're going to see price do is that from a bullish structure, price will now begin to sell to the downside. So the reason why we have the reason where people actually got the name break of structure from, or market structure shift, is just because when price trades below two structural points, the moment you see price break below two structural points, it means that price wants to shift its original directional bias from a bullish structure to a bearish structure. So what that means is that the same way it is in a bullish condition is the same way it is in a bearish condition. So it means that price can start to give to us what we call a consecutive higher high and lower high and lower low, lower high and lower low, right? Lower high and lower low, right? So just like we said in a bullish market condition, right? We want to say the same thing in a bearish market condition, right? That the two major characteristics or three major characteristics you need to know is that every higher low, every lower high and lower low created is a what? External range liquidity. Every lower low created is an external range liquidity, and every lower high, these are the lower highs here, right? All of these lower highs, they are what? Internal range liquidity. All of these lower highs are internal range liquidity, or they are also structural points. So when we say structural points, it means that there is every possibility that price can trade above all of these structural points, right? The moment price trades above those structural points, price will start to move to the upside, right? Price starts to move to the upside, right? So the essence of the structural point is that what we call structural point break, or people call it break of structure. It's not necessarily about the name. It's being able to understand the logic behind what price actually does after that. It means that if price trades above, sometimes price doesn't have to break above two structural points. Sometimes price will just have to break above just one structural point, then it will shift its directional bias from a bearish market to a bullish market, right? So the same way it is, right, in a bearish market condition is the same way it is in a bullish market condition, that every time you see price trade below a particular structural point, sometimes it could be one, and sometimes it could be two structural points. It indicates that price is going to shift its directional bias from a bullish market structure to a bearish market structure. So I said the basics, right? One of the things you need to know are the characteristics of a trending market, right? That for every higher high created in a bullish market condition, they are known as external range liquidity. And every higher low that is being created in a bullish market condition, they are known for two things: internal range liquidity and external range liquidity, which means that we have explained what structural points means here, right? That when price breaks below a structural point or two structural points, price is going to shift its directional bias and continue to move to the downside. Then we spoke about is that knowing that in a bullish market condition, every higher low created is not just a structural point, is also an internal range liquidity, which means that every low year, right? Oh, when we get to range circle, I think that's one of the best things I love to teach. Range circle and key levels, right? And liquidity, right? When we get there, oh, I love it. I love range circle a lot, right? Because range circle is one of those things that it's just a combination. Range circle is a combination of advanced market structure, liquidity, all of those things. So it's I feel like range circle is even a missing piece for so many people in their trading journey, right? So when we'll get there, we'll talk about it, right? So so you see that I said that aside every higher low being created as a structural point, it is also known as an internal range liquidity. So what that means is that if price takes out an internal range liquidity, price would actually move to go and take the external range liquidity. So the beautiful thing about this is that price can take out, the way you get to know if we have broken structure, right? We have broken a structural point is how the candle closes. So what that means is that if we close above or we close below two structural points like this with a body, right? The moment we see the way the candle closes, right? Price starts to trade from the top here, right? So price started to trade from the top and traded down to the bottom, and it closed below it as a body. So the moment it closes below it as a body, it indicates for us that price has broken structure. So, but there are times that the difference between this structural point break and this internal range liquidity is that price can actually trade from this top to this bottom and take out two structural points, but it's not going to close above it. It's not going to close below it as a body. If it closes below this particular structural point as a body, we know that the bias is going to shift from, bullishness to bearishness. But, because we also know that all of these higher lows that are created in a bullish market structure are also internal range liquidity. So it means that there's a possibility that price is going to take out those two structural points, use them as internal range liquidity and close above. So what price is going to do is that price is going to close above them like this, right? So you see that price will trade, below them first off as a body, but over time it's going to react and close above them as a wick. So the moment price closes above them as a wick, we know that what price did was actually used these two higher lows here. Price used them as internal range liquidity, right? So internal range liquidity. So one of the ways you begin to understand if price is going to continue a particular direction, right? Or price is actually going to shift its direction, it's in the candle closure. Candle closure is very important. When we talk about storyline, so when we get to the point of storyline, you must understand candle closure. It is very important, especially on the weekly and the daily, and even 4 hours too. It will help you a lot. How a candle closes on the higher time frame. In fact, if you master that one, I mean, you would never go wrong with the directional bias. You can go wrong with your entry, like you can have missed entries, you can have like maybe sniper stop loss, right? And all of those things, right? But you will never go wrong with the direction, right? The moment you understand candle closures. So you see the difference between a structural point break is that price closes below it as a body, right? Closes to below two structural point as a body. Sometimes it might be two, like I said, and I'm putting a caveat as well, that's like a disclaimer as well, that it doesn't have to necessarily be two. Sometimes price can close below one as a body. Then the moment it closes below one as a body, we should expect a shift, which is a break of structure. Then there's the other one. I said that every higher low is not just a structural point. Every higher low is also what we call their internal range liquidity. So you see that price after taking out, after price has taken out this external range liquidity here, right, price will begin to trade with a heavy momentum to the downside. So what price is going to do is that price is going to take out two, price will take out this one, price will take out this one, number two, right? After price takes them out, now we want to pay attention to how the candle closes. So you see that price will start to reject, then this candle is going to close above it. Let's say, for example, this is a 1 hour candle or a 3 hours candle, right? So it means that what price did was that price actually wants to use, it didn't shift. This is not a break of structure. What price did was that price came to take out two internal range liquidities, right? And now we expect price to continue to move to the upside until the next external range liquidity is being taken, right? So that is that about the bullish market condition and the bearish market condition. Another one we want to talk about is that there are times where you have price might not be in a trending market condition, right? There are times where the market is just going to be consolidating. So what that means is that in a consolidating market, you're going to see price, behaving somewhat like this, right? Price is going to be price is going to just be consolidating like this, right? So the moment you see price actually consolidating like this, so the moment you see price, so the moment you see price consolidating like this, the primary purpose for a consolidating market, right, is that price wants to engineer liquidity, right? Anytime you see the market consolidating is just for one particular reason, right? The reason is for price to, engineer liquidity. And majorly, you're going to see a consolidating market like this, especially in the Asian session. Asian session gives to us the consolidating market. So what that means is that, two things are likely going to happen whenever the market is consolidating, or there are two major things I expect price to do in a consolidating market. The first one is that I want to see what we call a manipulation, right? Like I said, anytime you see the market consolidating, right, the price would actually create for us what we call a liquidity at the top. ICT calls it buy-side liquidity, and a liquidity at the bottom. It calls it a sell-side liquidity. Like I said, it's not really about the name, right? It's going to be very, not so good knowing the names, but you don't know how it works, right? So you see that there's a liquidity being engineered at the top. There's also liquidity engineered at the bottom. So one of the things you see we expect price to do is I expect price to give to us a manipulation and an heavy momentum push to the upside, right? So whenever the market is actually consolidating, right, I expect two things to happen. The first one that I expect to happen is that now the price has actually engineered liquidity at the top and has also engineered liquidity here at the bottom, right? So one of the things we expect price to do is take out, manipulate any of these ones, right? So you see that price is actually going to manipulate this particular liquidity at the bottom. After manipulating the liquidity at the bottom, it follows all the time with an impulsive move to the upside, right? So you will see price, price is going to move up to the upside. We are going to see price move to the upside. So that upside move is what we call a displacement. Price is going to give to us an heavy push to the upside. The moment we see price give to us an heavy push to the upside, it means that we already know that price wants to create a new, we now have a trend, right? Price wants to continue to move to the upside, right? So, yeah. So, so we have a consolidating market indicating that the market doesn't have a directional bias. Then we have a manipulation following with an impulsive move to the upside, which is very important, right? It's in the impulsive move to the upside. Then the next thing we want to see is that the moment we see this impulsive move, it gives us an intel that the market wants to continue to move to the upside. So the second action I always want to see happen in price, right? Every time that the market is consolidating, right? This one happens almost all the time, right? This happens almost all the time. And this is what I'm trying to explain to us during, like, it's a London setup, like a London session setup where Asian session will consolidate and create Asian high and Asian low. So both liquidities are still going to be standing, only for price to take out the Asian low, react from a key level on maybe on the 4 hours, and you have that massive displacement to the upside. Price will just continue to move to the upside, right? The second thing I want to expect price to do, these are just the two things I expect from Asia. I mean, not Asia, like anytime the market is consolidating, right? So whenever the market is consolidating like this, it's very easy, right? So anytime we see that the market is consolidating, you will see that if you move to the line chart, you will see that price is creating an A-shaped key level and a V-shaped key level, right? So aside that, whenever the market is actually consolidating like this is the last thing I want to see price do, right? Anytime the market is consolidating like this. This is what people, the support and resistance trader they call it break and retest. So what I want to see is that, remember what I said, whenever the market is actually consolidated, the market creates for us what we call engineered liquidity at the top and also engineered liquidity at the bottom, right? So like the first one, we want to see any of these liquidities at the top or bottom manipulated, followed with an impulsive move to the upside, right? Why for this second one, we want to see price is not going to actually manipulate any at all. What price will just do is that price will trade lower. There's no manipulation of any of this. What price will just do is price will trade lower, give to us an impulsive move to the upside, right? That impulsive move to the upside, price will now come back to that same key level, right? The same key level that price has actually been, all of these key levels here that price has been buying, selling from, bouncing from, right? This place, price sold from here, sold from here, sold from here. Now we sold from here the last time. Now we broke it, disrespected all of those key levels. So there's every possibility. The second thing we want to expect price to do is that price was, going to create for us an inducement liquidity, tap into that same key level that got disrespected, and we'll just continue to move to the upside. So these are the two major things whenever the market is consolidated, right? These are the two things I always want to expect, right? That if price does not manipulate any of these liquidities being created, and give to us an impulsive move to the upside, there's every possibility that that same level, right, that price tapped once, second time, the third time, fourth time, and we sold from that got disrespected, there's every 80% possibility that price is going to come back to that same key level and just continue to move to the upside. And what I always say is that, the logic behind it is that if the same key level is overlapping inside of an imbalance, and if it has an inducement liquidity close to it, right? Somebody asked me a question one day and said, sir, there are times that I see trades like this. He was saying that he has missed a lot of trades because after price disrespects a particular key level, is waiting for inducement liquidity to be created, only for price to tap that key level and price starts to fly, right? So that is one thing about trading. You can't expect yourself to be catching all moves, but there are people who are rugged enough. They believe in their trading system like mad, that if price creates an inducement liquidity or not, right? As long as that key level is actually overlapping inside of an imbalance, right? They are looking to just take it from that level, right? With maybe like a wider stop loss, like 10 to 11 pips. And you will see that there might be in a little bit of drawdown, but price will still go in their particular direction. Then there are others who are very conservative, right? Even when they have seen that the setup has even formed, right? They are waiting for price to still create a confirmation entry before taking the trade, right, and all of that. So he was asking and said, what do I do? And I told him that, you can't expect yourself to catch all the trades, right? But if you don't want to follow confirmation entry, if you see that everything is in check, you have a key level that is overlapping with an imbalance here, right? You can just take the trade directly, give it like a 10 pip stops. Give the trade enough space to breathe, right? And watch it just play out, right? And all of that. So these are the two major things that happens whenever the market is consolidating. Like I said from the beginning, it is never always going to be picture perfect. What I mean picture perfect is, the market will just be, creating higher highs and higher lows like this. It's just going to be creating. No, if it was picture perfect like this, many of you will not even be on this call already. You won't be on this call, right? Everybody would have been a billionaire by now, right? So the reason why that's what we just spoke about, aside the Asian session, aside the type of structure where the market actually consolidates, right? The reason why that one is different, we consider others as theory, right? We consider others as theory. Sorry. So the reason why we consider others as all of that as theory is that when it comes to the marketplace, right, what people choose to call algo structure, right? I don't know the reason why they call it algo structure, but I don't mind, right? I'm also learning. I don't know why they call it algo structure, but at the same time, some chose it to call it advanced market structure, which is, like I always say, just pay attention, follow my instructions. It is never about the name. It is about understanding how to use it to your advantage. In fact, that is the major thing, right? See, let me tell you something. There are a lot of traders on Twitter who doesn't even know. There are a lot of traders that I even know, say they don't even know the meaning of liquidity. They don't know anything. They just know the basics and they are doing fine. And that is why I've tried as much as possible. See, if you comes to study, God, my journey in trading was quite a lot. I've studied ICTs materials. In fact, I studied to a point I was tired. My head was hot. I had to take like 1 full week off, right? I was learning central bank dealers range. I was learning, and I figured out that, man, all of these things, they are good, but it still falls back to structure and liquidity actually. So my chart now, in fact, if I want to take a trade now, the only two things you'll find on my chart, this tool to find key level and my long or short tool, right? These are the two things you always find on my chart. You won't find any plenty thing again. I don't need all of those things anymore, right? And yeah, it works, right? So when we talk about advanced structure, what people choose to call algo structure is just to, the logic behind it is that when price is trending to the upside, right? Price creates consecutive higher highs and higher lows, right? So price would always come back to take out the internal range liquidity that is being taken, right? Price would take out the internal range liquidity taken. Price would always engineer liquidity. Then price would always sometimes come back to what we call the breaker block, all of those things, right? So stuffs like this. So let me show you what people call the advanced market structure. So I'm going to explain everything from beginning to the end, right? So what we talk about advanced market structure. So what people talk about when it comes to advanced market structure is simply that, now look to the left, you will see what I'm talking about. What they will talk about is, I said to us that every time the market is trending to the upside, higher high, higher low, higher high. I told us that every higher low created in a bullish market condition it is two things. Every higher low created is that they are considered two things. Number one, they are considered as internal range liquidity, and number two, they are considered as structural points. Structural point used for break of structure or market structure shift, right? So now when it comes to advanced market structure, this is what it's all about. So what they're trying to say in advanced market structure is that, when the market wants to trend, right, the first thing that the market creates for us is what we call a strong low, right? In a bullish market condition, the first thing that the market is actually going to create is the market is going to create a strong low, right? After creating a strong low, right, price is going to take out internal range liquidity. After taking out internal range liquidity, price will always go to take out the external range liquidity. So let me explain this first part, right? So the first part says that for advanced market structure is that for a structure to start its formation, right, or an order flow to start its formation, the first thing we're going to see is a liquidity sweep followed by an impulsive move to the upside that gives to us a break of structure. So we have liquidity sweep, impulsive move to the upside that gives to us a break of structure. And the next thing we now begin to see is that price is going to give to us an order flow to the upside, right? So price will create a higher low, price will create another higher high, right? So the moment you see that price has actually created the higher low and higher high. So what I mean now is that price is going to come back to this internal range liquidity that has been created, right? And price will, so we're going to have something like this. Price will come back to take out the internal range liquidity, then price will run to take out the external range liquidity. So all they're just trying to say to us is that when it comes to advanced market structure, is that you will hear people who my screen is not showing. Can somebody else confirm, please, if my screen is showing or not?
It's showing here. Maybe you should check your side.
Please check your side and your network, please. Thank you. So let's continue. So if you heard on Twitter, like maybe on any other social media platform, people will tell you that my stop loss is your entry, right? The word my stop loss is your entry, right? It's gotten from advanced market structure. So what that means is that automatically at first, because of the basic understanding of structure, there are people who would want to be buying from a particular order block here, right? Many of you would want to be buying from a particular order block before. You want to buy from a particular order block, and from that particular order block, that order block was responsible for the impulsive move that led to this up move. That it was responsible for the impulsive move to the upside. So naturally, you want to see price come back, they say mitigate. Want to see price mitigate the other block, then continue to move to the upside, right? So naturally, that is what you're expecting. So if you were looking to buy from this particular order block, right, definitely your stop loss is going to be at the opening price of the particular order block, and your stop loss is just going to be below this particular low. Your take profit is just going to be above this particular high. So naturally, people who understand just the basics, they are looking to buy like this from this particular order block, and price will continue to move their direction. So is their directional bias correct? Yes. what will now happen? So when you hear people say, oh, your stop loss is my entry. So what they mean is that where your stop loss is, right? This place, let's just, for clarity's sake, let's say your entries are that open of the other block and your stop loss is just below this low. So now where your stop loss is, there are people who have their entries here, right? Because the market is liquidity engineered. What that means is that the market thrives on liquidity, right? The market is always looking to attack liquidity. I've said it a lot, that there are only two assignments that the market have, right? The market seeks to attack liquidity and also to rebalance and hold imbalance, right? So now you are looking to buy here, and there are people where you have your stop loss. That is where some people have their entry. So that is where you hear the word, your stop loss is my entry. So what that means is that for you, price will tap your entry here. After price tags your entry here like this, price starts to go in your direction. You take a screenshot, post on WhatsApp status or on Twitter and say, killing the market, killing the market. Before you finish your tweet on your Twitter, before you post it, with the moment before you are done posting it and come back to your MT4, price would have hit your entry out, snipe your stop loss. The same way you had a sniper entry that you went to post, that is the same way price will now give to you a sniper stop loss, then price will not go into your direction. Now, you will not post your stop loss here that happened, right? You're not going to post it here because you already tweeted that you took an entry, right? You had a sniper entry, right? And before you were done posting it, price gave to you a sniper entry, gave to you a sniper stop loss. So, but those people who had their entries where your stop loss was, they got the direction right, right? So that is why they will always say where your stop loss is my entry, right? The word your stop loss is my entry is gotten from, just a point of people who they call them inducement traders, right? So which is not really, so it doesn't really matter like that. So all I'm just trying to say to you is that when it comes to advanced market structure, right, after price creates for us what we call a strong low, right, which it becomes the foundation or the formation of a particular structure, right? How is a strong low formed? We must have a sweep and a break to the upside with an impulsive move, right? Then price gives to us a complete order flow to the upside, right? Meaning that price will create for us higher high, higher low, higher high, right? So what do we want to do? We want to look to take out the higher low. Remember what I said in the basics of market structure. If you understand the basics, it will be very easy for you to understand, this advanced structure. So I said to us that in the basics of market structure, I said every higher high created is an external range liquidity, and every higher low created is considered two things. Number one, structural point, and also considered as a what? It is also considered as an internal range liquidity. So the overall explanation of advanced market structure is that what they just want to make you understand is that price is always seeking to attack liquidity, meaning that price will bounce off from internal range liquidity, and then it will bounce off from external. It will bounce off to external range liquidity. So in advanced market structure, there are a few things you will actually see. Number one is that after price takes out the internal range liquidity, right, we will see what we call a continuation or an expansion to the upside. And when price takes out an external range liquidity, we are going to see what we call a reversal. We are going to see what we call a reversal. Then when we take out another internal range liquidity, like something like this that we have here now, we just explained this particular phase, right? We've not explained this particular phase, right? So the second phase is where price engineers its own liquidity now, right? Price engineers, right? So pay attention to what I'm saying. Price engineers its own liquidity. So I said for internal range liquidity, after it is taken, price will give to us an expansion to the upside. Then after external range liquidity is taken, price will give to us what we call a reversal. So the moment price begins to reverse, you know that our strong low is from this place here because we swept this liquidity and we broke structure. Our strong low now moves from this place to here, right? Because now we have swept liquidity, we have broken two structural points, one and number two. We have broken these two structural points. So what price is going to do most likely is that price is going to engineer liquidity for us like this. So how we price engineer liquidity, right? From this low that we had this sweep and this two structural point break to this high, right? So from this low to this particular high, you would notice that inside of this low to this high, price will trade lower, then price trades higher, but it will not take out this high, right? The moment you see that price trades higher, but does not take out this particular high, please mute your mics. So the moment you see that price trades above, but does not take out this particular high, which is this external range liquidity, just know that from this range low to this range high, the lowest low inside of this range low to this range high, the lowest low becomes your engineered liquidity, meaning that this low created becomes your engineered liquidity. So what do you expect? That low becomes your internal range liquidity that needs to be taken. So price will take it out, and then price will continue to move to the upside. So that is what we are trying to say here. So look at this. So you understand what happened here. We swept liquidity here, then we broke structure here, then price did not engineer liquidity. Price came to take out the higher low that is going to serve as our internal range liquidity. Then after we took out the internal range liquidity, price came to take out external. So you'd notice after we took out internal range liquidity, we bounced off to the upside. We took out external. The moment we took out external, what did we have? A reversal, right? Now our strong low is going to move from this low, is going to move to this low. Why? This is a new sweep. This is a new sweep of liquidity that we have that is following with this particular break of structure, right? We broke above this particular high. So what did price now do? You will see that price has now engineered its own liquidity. Wow. You see how price traded to the downside, traded to the upside, but could not take out this high, right? The lowest low from this low to this high, inside of this low to this high, the lowest low inside of this low to this high becomes your inducement liquidity or engineered liquidity. It is going to serve as your internal range liquidity. So what would price do? Take it out, and price will continue to move to the upside. So let me show you. I think I showed us one particular example from Monday. So if you look at Monday straight, okay, look at this. Can we talk about premium and discount today? Yes, we should be able to talk about it. Please don't go anywhere. This is almost 5. Let's meet one more time again, right? Let's meet one. Yeah, so Mr. Alex, so you can see, I'm just trying to reiterate. Sorry, guys, let me nosedive a bit. So you can see if you were in this trade, can you see how the trade is already? This is already a 1 to 2 already, depending on where your stop loss is. So you can
Yeah,
see
same.
the only thing I can.
Same. You know what I did? Sorry. What I did, I had to go and cancel my what is it called? My
Trade.
my limit order.
Ah,
Because we were analyzing this trade from that 3 hours that is going to that like it was selling. That's why I had to go and cancel this. I need to complain here. I had this earlier. In fact, I think I sent it to the group or I sent it to someone. I had this trade coming, and when you now the earlier call where we were now talking about
hold
this
on. Okay, sorry, hold on,
three
Mr.
hours.
Alex. Hold on.
Yeah.
You know what? I want to send another link so that we can cover all that things together. So just hold on. Everybody join with the last link for today, right? Let me end this call because this one is about to end. So I'm sending a new link so we can finish up together all at once. Yes, trust your analysis, just like Olawale said, trust your analysis.